Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Angel Gonzalez. Angel is a seasoned veteran in the financial sector, bringing to the table over 19 years of experience spanning finance, banking, executive management. His career marked by roles in Fortune 500 companies showcases his expertise in a diverse array of industries, including accounting, capital management, marketing, and consulting. His journey in real estate began in 2005, starting with a portfolio of single-family homes. However, his vision extended beyond the conventional, lending him to the dynamic world of commercial real estate and syndication. This shift not only broadened his investment portfolio, but it also underscored his ability to adapt and evolve in a rapidly changing industry. Angel, welcome to The Wealth Flow.
Well, Keith, thanks for having me, man. You made me sound better than I usually think of myself, so I appreciate that.
Yeah, not a problem. And I'd love to dive into your story. Angel, what I usually do, we'll start with kind of where you grew up and what eventually led you to this wonderful world of real estate.
No, thanks for asking that. I would tell you, so I'm actually come from an unconventional side of things when it comes to a lot of my peers. I'm actually from Panama originally, so I went from Panama, lived in Minnesota. Minnesota is pretty much where I did all of my high school, college career, happened in Wisconsin, Minnesota. And then from there, it kind of springboard everything. I actually got into banking by accident. I have family in financials and things like that, but I actually was the guy who was like uncertain what they wanted to do after college. And I actually was supporting a roommate of mine and good friend in his journey, wanting to get into, at that point, Wells Fargo. And it was one of those situations that I actually just happened to be the ride. And as I was sitting there waiting, I ended up striking a conversation with a gentleman, not realizing that that was the district manager that was hiring for the roles during that time period. And unfortunately for my friends and for the people that were there, I ended up getting the role and they did not. And so that's how it started. It was kind of like, wait, what? Happenstance a little bit. But that actually kind of led me into kind of the whole financial world and really understanding a lot of that. And so it was really unique. Because when you start at a level that I did, which was just as a banker, you kind of just are like, hey, I don't know what's exactly all this means. I don't understand the greater economics of things. I'm just here to serve and help the clients with their checking, savings, things like that. And that kind of just led the journey on a path that I could be more grateful for, because I got to understand a lot about the infrastructure of finance and infrastructure being essentially led me to a finance director roles, executive management, and commercial real estate managing partner type stuff. And I'm just sitting here like, sometimes it feels like a whirlwind, but I'm so grateful for this journey because it did lead me to understand things in a more intricate way, because I saw it from the back end where people are typically not able to understand everything that's kind of working in these arenas.
Yeah, it sounds like some great experience for kind of what you're doing now. And so tell me a little about, when you started to invest in real estate. It sounds like maybe in the single family space initially.
Yeah, well, I started investing in a single family space really shortly after really working in the financial world for about 2 years or so at that point. Because, you want to, at that point, I actually came into the industry of finance at a unique time. Why I say it like that is because if most people understand when you talked about mortgages and finance and all that stuff in the like late 90s, early 2000s, it was kind of the Wild West a little bit. It was a lot about people could get housing and all these different things on stated income, stated assets, things that weren't real at that point, just because that's the market and that we were in. The thing that was unique is that I come from a conservative family, so I still took a more conservative track. I had an uncle in high school that used to help me, have me help him fix up homes. And I didn't realize till later, though, I was doing it at $40 for the entire projects, not like please. So looking back, I was like, wait a minute, I saw what he did, but it was really valuable information that I gathered. But that led me to, as soon as I was able and felt established that I had enough money and enough credit and all that stuff, I went ahead and bought my first house with the full intentions that it was going to be one of those moments where I would just buy it, rent it, and then kind of let it kind of happen. And I was very naive because what I didn't realize is you still have to have the house perform in a certain way. You still have to be a landlord. So you have to like mow and worry about all these things that I'd never thought of. But that was kind of where it started. And I just started doing one acquisition after the next until basically the market kind of crashed in '08. But by that point, I already had kind of built up. I think at that point, I was closer to like in the teens, low teens when it came to homes that I had.
Hmm.
So unfortunately, I had to make quick pivot decisions, and others I was able to hold on a little bit longer as I continued kind of building up the knowledge base, I will say, when it comes to the single family side of things.
And where were you investing in these, Angel, at that time?
I was primarily investing in Minnesota, but what I would focus on is were areas by colleges. And the reason for that was that I always knew that college students needed housing. The desired house didn't have to be like luxury. It had to be functional, really, and it had to meet certain needs. And so that's kind of where I started at that point. And then over time, I started going into more suburbia and other areas, and then the lakes after that. But ultimately, the bulk of the time when I did the single family was around college neighborhoods.
Okay. Okay. Yeah, that's just definitely an interesting model, and they always have to have places to live. It's kind of weird though, depending on I don't know how it was with yours, but a lot of times it just the move in, the move out is a little bit different. But or you can get somebody who comes in and remains there for their 4 years or whatever. So it can work out really well.
Well, I will tell people, and more than anyone that's listening and thinking about doing that, remember when renting to college students that they're not going to take care of your environment or the home where you think they would. In the beginning, I definitely was very loose. And by the time I was done, I was like renting to like a certain age group, gender. Like it was like,
Right, right. No, that makes sense. That makes sense. I know that with both of my kids, they always want that guarantor and, to lock you in as well so that, you're sure to take care of the asset.
yeah.
So, and so you did that and for quite some time and up until what about '08, and then you shifted gears a little bit. Tell us maybe a little bit about that.
Yeah, so I did that part, and that was kind of like more of I don't want to call it the side hustle. The idea was, as much as possible, was to get to a point where I kind of let go of the W-2 job. The unfortunate or fortunate part of the journey is that that never happened. It actually became more of the secondary thing I was doing, and then my W-2 job kind of basically took over. And so right after that, I kind of got to kind of what they call a fork in the road where I had to decide like, what am I doing, and can I be good at any of these things if I'm only doing it in a half kind of way, And so it was one of those kind of situations where I had then basically a pivot point in 2012 where I decided that around that time period that I had to change my life. A lot of life events happened. And it was kind of one of those moments where it was like, you know what, I'm going to go ahead and liquidate anything I have left that is single family or that kind of thing. I'm really ended up focusing then on my next journey, which kind of led me into executive management, which is something I heavily dove into for the next, call it 8 years. And then
Okay.
point, it positioned me to be able to conceptually, I always knew about real estate. I always read about it, but I kind of got out of the game for a while. And then finally, it was one of those things where I was like, wait, there's a way I can do everything I was doing in the past more effectively, more efficiently, and most importantly, with the same bandwidth. And it has a lot more output. I was like, wait a minute, what is this? And all of a sudden, I got into the world of commercial, and that's where everything changed. And no longer do I have a W-2 job. Now I focus solely on on managing our business.
Okay. Okay. And what type of commercial real estate did you get into?
Yeah, that's a great question. I actually did something very unique. The person I ended up, so one of the things I would advise everyone, always try to find a mentor or somebody who's already doing something at a high level, because it kind of shortens the learning curve. And quite frankly, allows you to get into the action steps a lot quicker. So I went ahead and aligned myself with someone that was heavy into office space. The thing about office space at that point it wasn't what it is today, right? COVID has
Right.
happened, and people are working from home and all these things. At that point, it wasn't like that. It was something where I was able to learn a lot about the lease structures and all the different things that are kind of compiled in the office. And then that led me to a world where I started reading kind of the tea leaves, in a sense, where it was like, wait a minute, where we're going, there's no longer do I think office buildings and brick and mortar are going to be serviceable the way they used to be. I don't think that we're going to ever do away with them, but I think that there's going to be a heavy dependency on doing more things online in different ways and connecting with people. So I pivoted to industrial pretty quick. It was one of those moments where I'm like, I understand everything about the structure of leasing and all these different things at this level. And so, how can I leverage that to a product that makes more sense to basically having tenants and things that also align better with kind of where I felt that I could really deliver on. And then the last component of it is I knew everyone I knew was in multifamily, and especially as they were starting to run into headwinds, I started realizing, well, it's better for me to position my business and our company into really focusing on industrial and some of the other asset classes, and then partnering with multifamily folks on more of like a syndication model style or funds of funds, and then doing that on the multi side. And then that way I can stay in my lane, but more importantly, leverage the people around me that are good at what they're doing.
Okay. And so how long did you well, and there's certainly parallels, right, with office to industrial. Different asset class altogether, but you're still working with businesses, leasing to businesses versus multifamily where you're, leasing to residential. But how long did you stay in the office space before you pivoted?
Yeah, so I was probably in the office space for about a 2 to 3 year period of time before I started realizing the real shift in the market was coming. And then from there, we've kind of pivoted about now a couple years now, and then from that point, it's been a lot different of a journey. And the combination, I tell you, industrial and then having a little bit of that multifamily sprinkled in has actually been a way better pathway than what we had going on before.
Yeah. Okay. And so let's talk a little bit about the industrial. Tell me what type of industrial you're focused in, and then also geographically, kind of where you and your team are investing.
Yeah, great question. I would tell you right off the bat that let's talk about industrial. So a couple of things I want everyone to know. The first part being is that remember that when a lot of times in our lives, there's going to be things that are outside of our initial influence that have the ability to basically change the lens that we look at things through. What I mean by that is the government already basically had decided that they wanted to spend the next decade, and they came out and said it. It was like, hey, we want to bring back everything to the US grounds, or at least North America's, right? So they
Mhm.
started talking about the fact that they wanted to do some onshoring, reshoring, all these things you started hearing a little bit of whispers about. And so one of the things I always will tell people is listen to the information that's being provided if you can, because the more you can lean into that information, hopefully it helps you with some of your decision making. So we started with that. The next component is I started trying to figure out where are the goods and services that we are going to play in this game, where are they going to be coming from? Well, in America, you're going to realize that you're going to get things in one of few ways. You're going to get things either through highways or through ports. That's pretty much going to be your two things that are going to be happening, right? Or the movement. And so what I started realizing is that you can either play on the port side, going or basically like the Mississippi and a couple other things, or you could be like us that we focus on really the region of. So if you think about Colorado, we think of everything from New Mexico from Mexico to Texas is kind of the zone we like to play in. The reason why is because a lot of factories and different things are happening in Mexico. A lot of our alliances are happening there. We are going to do a lot of things that are more partnering, I guess, again, with the North Americas. So that's what we decided to focus our energies on. When it comes to the product type, we like to be very open to different products, but the one we really is starting to feel that that we can do better is the industrial service facilities. And why that's important for people is that a lot of times in industrial, you're going to be looking for very key things. And here's what they are. The first one is you want to make sure that you can move the goods. So do you have access to roads, highways, waterways, whatever that is readily available to move the goods as quickly as possible. The other thing that we always think about is height or space or clear heights. Goods and services in industrial are usually housed in a certain way. And so we always wanted to kind of understand, okay, for us, there's a minimum height or ceiling height, which usually is 16 for us. You do see a lot lower, smaller places, 12 feet, but we focus more on that 16 plus. North of 20 is even better because those are going to be where you can do a lot more movement of goods, a lot more storage of goods, things like that. But then comes the ISF or industrial service facility is what is happening outside of and on the dirt, right? Which is one of the things you'll realize is a lot of companies, once they fill in the buildings, they still have more goods and services that might be equipment based or whatever it might look like that goes outside. Those areas are important. So these are areas that typically have great lighting, have fence around them or security, have the ability, again, to have easy access points for these companies to be able to do the day-to-day business. And so we started looking at those things and figuring out how we can help more on the ISF side of things. And we found that to be a great partnership between us and companies, because not only can we say, hey, look at this building, this warehouse, does this work for you? Then we turn around and say, and bonus, we have a yard or we have this space outside. Could you use this space? And now you're getting money on every square inch within the building. And you're also getting funds and money that is coming in because of the dirt outside. And we try to marry the two.
Okay. So are these, as far as size, how big, as far as the warehouse space, are we talking? And then same thing with that extra yard space. And are these single tenant?
Great question. So we personally feel that the multi-tenant space, so I'm going to answer it backwards, is kind of a better fit. And here's the why. And this is to any investor. I always think that if you can mitigate risk is mitigated on multiple ways. The first one being is if you can actually have multiple tenants that are sharing the same space, it allows that if for any reason one business or the other can't make their payments or they're not on track or whatever that may look like, you're not completely, SOL in a sense, right? You're not really just sitting out there and wondering like, oh my gosh, what do? I can't service my debt or whatever that looks like. So we like multi-tenanted facilities. I would say that if you are going to do multi-tenant, though, you got to be mindful of the fact that if you go below 30,000 square feet per sec, you're going to run into a lot of challenges because less than 30,000 square feet is really more dedicated to the single tenant user. And so usually the single tenant is going to be that, 3,000 to 20,000 square feet. And then you're kind of in no man's land between 20 and 30 because you're trying to decide what you are. We prefer facilities that are about 50,000 square feet or more because that's when you start getting into the more clearing. And that's when you start getting into those bigger Amazon-looking buildings, things like that, because that's kind of where the trend line is going, is that more people want that openness, that easy feel, drive-through opportunities and things like that. So we tend to focus more on 50,000 and up. And then when it comes to the land around you, If you can at least have 2 acres or more that you can actually really kind of divvy out based off of trucking or equipment or whatever that looks like, you also are going to realize that that could easily turn into anywhere from about, 20 to $100,000 more to the bottom line annually for
Hmm.
dirt side that people completely bypass.
Okay. Now, are these sectioned off like so? Say a 50,000 square foot facility. Are you looking at that being sectioned off in the kind of even areas as far as the warehouse space, and then is the yard just as needed depending on the tenant, or is it? I'm almost thinking like, if you were to look at like a single level triplex, right? You've got usually a yard that's immediately behind. Is that kind of how the setup is, or is it more of some of the tenants may require larger spaces for some of their trucking equipment, that kind of thing, and it's kind of as needed? I don't know. You tell me.
You got some good questions, Keith. I got to tell you because maybe I don't want to give all the secrets right now. I'm just playing. I'll first start off by saying the ideal initially when you start off in a building before you start demising or doing different things is you do want to have a plan of attack because a lot of times it is something where you ideally want to have it all kind of split equally. But what tends to happen is not that. What you
Right.
start finding out in these multi-tenant spaces is that you actually end up being where one tenant might take 30%, the other one might take 40%, the other one will take the rest, or whatever that may look like. So depending on the business need, and you got to be mindful of that going into it, you're going to see that your tenant sizes might be different. I think one that jumps right out of our mind. We have a facility that we play in, and that the one tenant actually had about half the square footage, but because of the need and the change of their business, they needed to give up some. Well, the other tenant's business was expanding dramatically, so they wanted that additional space. So now you're working out that leveraging point of saying, okay, well, tenant one is not needing all the space, but tenant two is needing all the space. How do we do that and not leave me with one tenant, right? And so there's a lot of like this puzzle pieces that you kind of do. But when it comes to the yard is unique. And not all yards are the same or outside facilities are the same. But the reason I bring it up is because you have to think about that real estate just like you do any other real estate: location, location, location. One of the things that I think amateur people that get into, and I don't mean to be rude, but when you get into the yard thing, they just think, let me rent this out equally. Or they'll just say, hey, you can have all of this dirt and just pay me $500 a month, and they just get excited about that. And you're not realizing actually you should be thinking about it as of what is your high or your best location in the yard and what is the low zone. What I mean for that, by example, there are some parts of a outdoor facility that you might get more rain in, right? Or it might be closer to water, or it might be something where you got to get a little further down to get to that part of the land. Well, that's where you're going to probably get the least amount for your rent. Where if you have the space that's like closest to the road, best lighting, and it's desirable, you want to make sure that you get the highest rents there. So you have to actually, if you want to be a professional about it, you should really be thinking about what is. So we call it zones, right? We zone them differently so that we understand it. Do we have an A, B, or a C zone? And that's kind of how I look at it: is A zones are your top, your C zones are your lowest desirable. Now, can you divvy it up where the need of the tenant? If I have a tenant that needs to move equipment all the time, they might want to be towards the front. But if I have a guy who just needs to set it and forget it more so, you want them more towards the rear. And so there's just a lot of dynamics at play, but we always want to make sure you always think about every part of the real estate should matter and they all should be weighted accordingly.
Okay. And tell me a little bit about the leasing. Is this triple net? And then also, is the facility, the warehouse space, on one lease? Then they have a separate lease for the A, B, C zone of the yard. What does that look like?
So if anyone didn't understand what he just said about triple nets, let's go back to
Yeah,
that.
let's do that. Yeah,
But
please.
when we start talking about leases, you really have to think about it like this. So when you're thinking office, you're dealing with what they call gross leases or modified gross. That basically means you have a tenant. they pay for an X amount, and you are, as a landlord, responsible for everything else. So they say, here's my money, you're responsible. You also have the triple net. So a triple net lease essentially is saying that you are responsible as the landlord for the housing of the building, meaning I'm responsible for the light, the shell, and think about like the fencing and things like that. That's my responsibility. But when it comes to the taxes, when it comes to the meters, when it comes to all the other responsibilities, that actually falls on the tenant. And so one of the things that I love about triple net leases, or more importantly, absolute triple nets. So an absolute triple net means I am absolutely, as your landlord, only responsible to make sure that you have a working facility. Outside of that, you're responsible for everything from the HVAC to the taxes to everything else. And at the end of the day, we can fix it for you. But what's going to happen? We're going to bill it all back anyway. So there is a reason I love industrial leases is because they are typically triple net or triple A, absolute triple net, which put us a lot of responsibility on the people running the businesses. The other component of it that is kind of a crucial part that I think gets missed on these is that you, as the landlord, are more of like a partner than anything else. Your job is really to align the business, be there to support them, help them understand where their needs are. But at no way, shape, or form is it like everything else. Like when you think about multifamily, right? You have a tenant, they pay a rent, you are again responsible. So actually, office and multifamily tend to be more in alignment. Well, that also puts a lot of pressure on the landlord side of things. Where on the other side, you're more of a facilitator. You're more of like the guy who's there to help them with their business strategies, growth, looking at it, their how you're looking at their balance sheet. So a lot of times they're providing you quarterly information about their businesses where you would not get that in the office or multifamily. So there's just a lot more that you are involved, but it's almost like you're involved in areas you want to be involved, and you can kind of like bypass the areas that you want no part of. So there is a lot of that when it comes to the triple net side of things. And then I'll throw that last component of it is that at the end of the day, when you are doing leasing from a standpoint of time, remember something. When you're talking about office, people expect to have a lease from usually a year to 3 years. If you're talking about multifamily, people could be changing their leases every year. When you're
Right.
talking industrial, the leases, because think about this, equipment. There are people who spend millions of dollars in their equipment inside of your building. They cannot just move that equipment without spending more money. And by the way, moving equipment is not inexpensive. So the leases tend to actually be a 5-year intervals. So we usually write leases at 5 years with a 5-year option. And then what you also find on other bigger tenants. So when people are renting long or doing leases on space of 50,000 or more, they are now looking at 10-year leases with the option of 10-year. So imagine now you go from a 1-year lease to a 5-year lease with an option for that, and all throughout that time, there's there's two ways that people do it. They either do a 50 cents escalator or a percentage, depending on the percentage or the 50-cent escalators. That happens like clockwork every year, so it's all built in. So you really can kind of bank on it better than you can in most asset classes.
Yeah, that's a great point. And it really, and it depends on the size of the industrial is what I'm finding. A lot of folks talk about oh well, shorter leases, but I could see when you are having those larger spaces that you're going to require, like you said. I mean, people are bringing in equipment. It's oftentimes they're building stuff that they're going to need in manufacturing, whatever it may be. Where it lends itself to those longer leases. And man, how secure is that, knowing that you're going to get that growth and rent, and it's like clockwork, like you said.
Yeah,
So,
I look at industrial. At least it used to not be. I kind of laugh at industrial because I'm like, if you go into a scene where you other are trying to date or do different things, industrial is not your sexy, it's going to get your attention type of a product. If
right.
anything, we're kind of that person in the back corner, maybe just having a drink. Um, but when
Yeah.
it comes to, in all reality, but when it comes to the performance, man, if people understood what was really happening sometimes in industrial, it really should be the other way, right? Like
Mhm.
it's more secure, it's more long term, it's more predictable, it's easier to de-risk. So there's a lot of factors that kind of drive that.
Yeah, for sure. And I guess tell me a little bit more about you'd mentioned on the geography from like Mexico up. Where are some of the places where are some of the states that you're focused on?
Yeah, so right now I'm talking from Denver, Colorado. One of the things I love about Colorado is that you have the access point that gets you from Mexico all the way up through Wyoming. So that's kind of a nice, easy band of highways that you can kind of use to get goods up that way. And then when you're thinking about the states, right? So states are kind of pivotal. You got Texas is pivotal, Arizona, New Mexico, Colorado, Wyoming. You're gonna get that's on this side where I play in. That's primarily the Texas as far as we go over, and then
Okay.
Wyoming as far as we go up. Now, a couple of things that we are kind of exploring is that we're starting to thinking about the Mississippi more. The reason why is because me being from a guy from Minnesota, a lot of my connections are up there. And so we're starting to find that the Mississippi plays a crucial role in how things are moving around, all the way from Minnesota down to the Louisianas and things like that. And so that's where we're kind of starting to venture into downstream, especially when we're thinking about ports. But for the most part, Mexico is what's driving a lot of this.
Yeah. And what type of businesses? Obviously, we see a lot of foreign car companies coming in, but it's not just that, right? There's a lot of other, and oftentimes when we're able to land, like in San Antonio, we were talking a little bit ahead of the show, but we've got the Toyota plant, which is huge on the south side, and they've just committed to some additional construction down there to expand even beyond that. But other states have that as well, and whether it be very very, I think Alabama's got like Kia, and there's a bunch of different ones all throughout, right? But it's not just the auto industry. There's other things that are being brought back here, and so what are some of the ones that you're seeing, and maybe the ancillary companies that kind of come along with them? Because it's not just those big ones, right? It's all the vendors and everything that kind of come along.
I think when you think of companies, always think about every company that has a product. Usually, back you mentioned it, great Keith, is that they have a support company. So, for example, I'll start with automotive because I know automotive very well. I was an executive there for a long time. That's where my executive track took me, and I
Okay.
can do this is that when you are in that space, you got to think about okay, so they build a car. What's all in the car? Where's all the technology coming from? Where's the tires coming from? Where are the nuts and bolts coming from? Where's the windshields coming from? You start processing the fact that there's a lot more than just the automotive shell that comes out of the factory. There's all these other factories too. So that's part one. Then you think about Amazon. Amazon is doing goods and services all throughout the US, right? So who's supporting these services and what kind of products is Amazon selling? So if you start thinking again, your mops and all the little goods and services that you use at your home, there are factories for all of it, right? And so one of the things that I've been seeing a big push on, for example, solar panel. Solar stuff, that's the solar panel is not just the panel. There are things in wearing like hardware and different things that as soon as a plant goes in that builds this, there's a bunch of other plants or companies around it that support that very company.
Hmm.
So you got to think about it from that standpoint. I think about even when we talk about defense, right? If you have any equipment that the government needs for defense, okay, the defense piece is being made, but now what is the powder and what is all these other companies that do their components to facilitate that good? So always remember whenever you think, I mean, I look at a bike. When you think of a bicycle, the framing of the bicycle may come from one place, the tires may come from another place, and the handles may come from another place. And
Hmm.
usually these and these smaller, call it the 10-foot, 1,000 square foot facilities, they're the ones that a lot of times are doing a lot of the little pieces of nuts and bolts and the things that come in the boxes that you put together that you have no idea that it took 3 or 4 companies to make that infrastructure for that one product. So I thought a lot of times I think that that's missed is that people think it all happens in one spot. And quite frankly, it's actually the opposite. It's a lot of pieces working together. So logistics becomes another thing that we think about a lot as well.
Yeah, yeah, for sure. And have you seen changes as far as that goes? Just shifts within the U.S. of where things were in the past and now where they're headed in the future. I know I was listening to some economist that was talking about these big shifts that are happening within the ports and the ones that are being used now and various things.
Yes, I think that's important to understand. Like, for example, a lot of times in the past, we would build one major factory to house something, some obscure place in the US, and that place drove everywhere else, all the goods across the country. A lot of times it's not like that anymore. Companies are trying to find out, like, they're looking for that local feel, or they're servicing a certain area. And so what you're finding is that there is actually this like breaking down now of a lot of these large giant facilities that housed everything in one place. And now instead of a company having one facility, they might have 5 facilities just with the same square footage across the nation. Why is that important? Well, it's a lot easier to ship things or move items or stuff if it's right here, right in your backyard, right? Where if I have to ship it from Denver to New York, there's a huge expense, let alone think about risk, right? If you're moving the goods from Denver to New York, what could happen between Denver and New York? A lot.
Yeah.
And so a lot of times what you're seeing now is that, first of all, things are getting more broken down into more regional and local community based. The other thing that you're seeing is people care about access points a lot more. So instead of putting a building in one spot just because it's wide open and you can get dirt cheap, now you're being like, no, just because I'm out here, maybe it doesn't make sense. I probably should be centralized to a lot of different businesses that can help my business. And you also got to think about the demographics of people. These facilities, someone has to work at them. So you always have to think about the labor force. And
Yeah.
so thinking about the labor force, you can't just be thinking about, like, for example, if you know that there's a bunch of engineers. So for example, I live in a place where the Colorado School of Mines is right here. Tons of engineers come there. Well, it would make no sense to have companies that need engineers be in a completely different area than where the engineers are coming out of. So a lot of times what you also will find is that companies also understand the labor force and are putting specific buildings or factories or whatever in sites that that can be supported by the labor of that area. And so that's another critical component of these goods and services.
Yeah. And so let's maybe shift gears just a little bit, Angel, and talk about the investment itself. What are some of the time frames as far as hold periods that you guys look at? What are some of the exit strategies? Just talk to us a little bit about the industrial as an actual investment.
So great pivot, because I think that's kind of where we tend to start there and then kind of work our way backwards a lot of times. And what I mean by that is we tend to know that in an industrial, we're, again, back to what I was saying, that we're not probably the most sexiest asset class. There's a reason for it. And here's why. When multifamily was exploding before the last couple of years and the rates were lower, what will happen is you can get really great returns and execute a business plan. Some people, I saw some of my friends were doing it within 12 months to 18 months. So they something, and 18 months later, they're like, I'm exiting. And I'm like, what are you talking about? How does that make sense? Where in industrial, the average the average hold time is about 5 to 7 years. That's the reality of it. And the reason for that is you work through that whole cycles, the escalators of the rents, you do all your renos, you want to make sure there's a lot of things that are happening there. But again, because of the longer term leases and the cash flow component, you typically don't need to move on from these asset classes very quickly because they hold, they retain, they execute the business plan rather well. So think about everything about a 5-year hold. That's going to be the first part. So unlike some of the other asset classes, the other thing we think about it too is where do we want to land that plane, right? That exit, when we are thinking about the exit, we typically want to make sure that we're north of about a 15 to 17 IRR. Those are really difficult things to do in today's economy, especially because we have to factor in rates. And so a lot of time in these investments, when we used to kind of be able to understand, okay, we can make this happen, because there was a time that you could get an industrial lender that give you a 4%. I think the lowest rate I ever gotten was 3.75. That's not the case today. In case you're wondering, most people, if you don't plan around 7, 8, 9%, like you're not getting the deal done. Well, that kind of squeezes into your margins. And
Mhm.
so a lot of times right now, we're kind of thinking through how do we make it make sense, especially being that we probably won't have a refinance or an event a little bit down the road because we want to make sure that we really maximize that exit. So we're having to be a little bit more patient. But it is definitely one of those things where we feel like if you buy right, it's very hard to get it wrong. So that's the first thing. And then the other component of it is that we think that time is always going to be on your side if you do it right. A mentor of mine who's owned a lot of property in real estate in the United States gave me one piece of advice that I truly will hold hard, and that is this: if you try to you can either have a cow where you try to milk it as much as you can right away and you're done with that cow and you sell the cow or whatever, you butcher the cow, or you can do milking the cow for as long as you can until that cow is no longer a cow for you. And so what I mean by that is that we believe that in the real estate game, especially in industrial, is that the time money value thing is always going to be important. And so if you can hold on to these a little bit longer, if you can really milk your NOI for a good period of time of duration, your investors are gonna win. And then those exits can be those exit or the events can be a good infusion, but making sure that it's after you've gotten enough out of that cow that as much as possible.
Yeah, makes sense. What about the debt on these this type of industrial? What type of terms? You mentioned interest rates and and that kind of thing, but what is the length of time that you're financing before having to refinance, and what's out there?
So one of the things that we always try to look for is we like to have things on a 5-year note, if not longer. With industrial, you can usually get between 5 and 10 years, somewhere in between there with no problem. You're starting to see more people, especially right now. Before they didn't do 7 years this much. Now 7 years is a thing that you're looking at. The one thing that I would also tell you is that be open to negotiating with your lenders to really focus on that 2 year, if not 3 years. Some are even doing interest only periods as well. So one of the things that I truly value is that if they give you that longer runway, take it. I think in the past, people were afraid, especially the people I work with, the lender says I'm going to get a 12-month IO. I'm like, did you ever ask them if they could change that? And they're like, no. I'm like, well, here I go. So I just make that extra phone call. Hey, is there any way we can make that a 24, 36-month IO? Almost not one time I've gotten a no. And so take advantage of that because that's cash flow to your investors. And that is another opportunity. So you're going to get that. The other thing is obviously the capital stack, I call it, is really important. So we usually try to leverage the loan somewhere around 65%. So there's two ways to look at it, right? It's LTV and LTCs, right? Loan to value, to cost. The thing I always focus on for me personally is more loan to cost. So if I can get more of that 70% where my costs or a little bit of that construction stuff is handled within that, I'd rather do that versus just an LTV. So just be mindful that there are the acronyms at play. Personally, get the construction and all that stuff in there as much as possible if it aligns, and then turn around and then get the rest from either your syndication or from the reserves that you may have.
Okay. And on your when you're going in to purchase these, are you looking at existing facilities and then you're doing some kind of a value add play on them, or are you developing some of them? What's your main strategy there?
I think, man, wow, that's a good one. The strategy can change as the longer you're in it. And what I mean by this is that initially it was the value add I always still think is kind of one of the best to get. But right now, we're having a little bit of a challenge between sellers and the market, right?
Mhm.
And what I mean by that is that now that people know that people are understanding more about industrial, the sellers have a higher expectation of what they want out of it and where they think they can be. And quite frankly, sometimes it's kind of out of nowhere. It's just, oh, it's industrial. People want to get in. They just pick something out of the air, and you're like, well, that doesn't make sense. So there's still this correction that needs to happen, I think, where people kind of need to get back in alignment. But what I would say is value add is going to be probably your biggest, your less barrier of entry, so that you can kind of, you're still getting rents. You're really trying to just tie in a couple of things. One of the things that I will always say with value add, what's nice about it is there's really three things in industrial to focus on right off the bat, right? So that's your lighting. That's going to be making sure that the facility has a way to being secured. And then ultimately, from there, you want to just make sure that you are leveraging the common area, common space type functions. If you do those three things, you ultimately are going to be setting yourself up for a win for the most part. Ground up is where I believe the future lies. And the reason I say that is because I think that we are going to find that there's still such a shortage of facilities and needs and things out there, especially in certain types of industrial. So the best thing that you can do is build it. And here's why. The other thing that's happened with industrial is the price per pound. There was a time where in a lot of areas you could get a square foot for about $70, $50 to $70 per square foot. Nowadays, the price per pound in some areas can be north of $200 per square foot, where it might cost you to build from ground up somewhere in the low 100s. Well, if you know you're going to be able to sell in the 200s and it takes you 100, 125 per square foot to go ground up, it's probably better to go ground up and then turn around and kind of sell it for that better profit margin and things like that. So I would say the least amount of barrier of entry and headwinds are going to be your value add, but your most productive / profitable areas are probably long-term going to be the ground up game, because that's where the business is going.
Yeah. Okay. Yeah, that's very, very interesting. There's a lot there. I mean, there's just a lot to think of when it comes to that. So, and you've been doing it for quite a while. And you said you do sprinkle in some fund to fund, multifamily as well. Where are you focused? Do you have some specific operators that you're kind of keyed up with, or what does that look like?
So great. I would tell you this, guys, that you have to partner with the good operators always. It doesn't matter in any line of business. The people you partner with matter. I tend to the areas that I'm focusing on, the multifamily front. I have a partnership with an out there with Well Capital. They do a lot of things out of Lincoln, Nebraska, Bismarck, the Dakotas, and then also they are focusing more on the Midwest side of things. Iowa is becoming an area of interest. And that's what I do when it comes to the multifamily, just because I love the Midwest. You don't get as much of the quick gains, but I'm going to tell you the sustainability, and like, you can almost watch it, man. It's like this really crazy band that it always seems to be winning, long term. So that's why we focus on that. And then when I look at some of like the SCR or other partners that are doing some of those things, I like to do that out of Texas. Texas and Florida are really two areas that we focus in on those kind of projects. And Missouri just came into play. I just got back from there. But now those are the kind of the focuses on that kind of assets. And then about the rest, call it 80%, 75% of our business, we just stick to the industrial.
Okay. Well, that's awesome. It sounds like you've got the industrial really dialed in, and it's cool that you get a chance to offer your investors some other options out there as well. Angel, how can people find out more about you if they want to connect, if they want to find out what you got going, what you're raising on?
No, I appreciate that. So anyone wants to connect, you can look me up at KeystonePrivateCapital.com. Also, the Taking a Leap in a Commercial Real Estate podcast. I tend to be more on the other end of the mic usually. And then the last thing I would just say, in all the major social media platforms, you're going to be able to find me, and I'm usually your Angel industrial guy over here. So I should be easy to find. So
awesome. Well, this has been really cool. I appreciate it. I've enjoyed it. And I've got two other questions for you that I ask every guest. One being just any advice you give somebody who's maybe just starting out in their investment journey.
Man, I think that the best piece of advice that I can give anyone is, actually, it was funny because I just ended a podcast a couple of hours ago where the guest took the words right out of my mouth, which is take action. I think that the thing that happens a lot is that we paralyze ourselves. All the stars aren't aligning. We don't have all the resources, or we don't have the perfect capital for whatever that may be. That has no bearing on taking action. Taking action is so many ways you can do that. And all I can tell you is do not get paralyzed by all the noise out there. Just start and keep going, because I believe in failing fast and failing forward. So if it's something where you fail, it's not actually a failure. Actually, it leads me to my next piece, which is if you either win or you learn. So they're automatically, by just taking action, you're going to learn or you're going to win either way. Either way, it's a positive. Where a lot of times I think that there are people paralyze themselves and don't take action and don't realize that they're missing on valuable opportunities by just sitting on the sidelines.
Yeah, I couldn't agree more. And I think I see a lot of that where people just get kind of paralyzed with spending too much time in the learning stage. I mean, yeah, by all means, you want to have a baseline. You want to be educated about it. But at the end of the day, if you don't take action, you don't get anywhere. So awesome stuff. How about a book recommendation? Doesn't have to be real estate related. I ask for the audience, but I always ask for myself as well. So.
No, I love that question, because right now I just got done. I'm one of those guys that has transitioned into the world of audiobooks.
Mm-hmm.
And if anyone just wants to actually start taking some serious action today, read the book, Burn the Boats. I would tell you that burning the boats is probably one of the things right now that, and it doesn't mean you just have to like disregard your life or anything like that. So calm down, everybody. But what it does mean is that if you are always thinking about the fact that you can pivot back to whatever that comfort zone is, you did not burn the boat. You really should always be thinking about, if I do this, I have no other option but to do what I'm doing. And ultimately, that's when you're going to get the desired results.
Yeah, I love it. Okay. And I have not, haven't read that one or listened to that one. So I'll put that one on my list. So I appreciate that, Angel. Well, this has been really cool. I really enjoyed having you on the Wealth Flow, and I think we'll call it a show. Thanks, Angel.
Hey, thanks for having me, Keith.
Yeah.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.